Let's go public for the first start of the chat, because it was a bit of a dismal end to 2016 for the tech stocks.
I mean, I think you had a lot of people sort of correcting positions, painting the tape, making their portfolios look like what they wanted to look like, as you often see at the end of the year. There was some strange movement in a handful of stocks in the last 5 or 10 minutes of the market. But overall, I think that what happened today doesn't matter, because what happened this year was really eye-popping in terms of returns based on limited success when it comes to earnings.
Were the returns eye-popping when it comes to the private market? You're very much focused in terms of the seed rounds, the Series A. Are things looking bright for 2017?
Absolutely. You know, we take a much longer view, 10-year cycles in our funds, and stay away from the day-to-day nuances of the public markets. But we are seeing larger funds being raised. We're seeing capital, although you may see 2016 be slightly below 2015 in terms of fundraising for companies. But we see that money going into deeper technology, AI, automation, and these things that will take several years to commercialize but have massive upside.
I think what's interesting for the theme of 2016, we're just hearing Cory say, you know, perhaps the funding amount wasn't the same as in 2015, it's a bit lower. The exits weren't really there for 2016 as well, and how much does that affect the ecosystem?
It was one of the slowest years for IPOs we've seen in recent memory, and we know that Snapchat's getting ready to come out, and so we might expect that may have changed, assuming the markets are ready to support that big IPO. But there have been a limited number of IPOs because the funding world has changed a lot, right? We've got a lot of companies that are getting funding very late stage. I mean, we were talking yesterday about the show BuzzFeed getting a G round. I mean, a G round. Who gets as a G round? I mean, companies aren't private that long, but this company is and needs capital at this point. We see massive raises by Uber, very late stage raises at a time when, and historically, companies would have already gone public. And as a result of that, although we expect some of these companies to come out, companies like Snapchat and AppDynamics and MuleSoft and Forescout and others, we still expect the employees of these companies and the venture investors are going to want to return. Eventually, they're going to demand that these companies get public. They can't stay private forever because of the kind of money they've taken in.
So maybe we'll see more companies coming to the market, Chris, but also will we start to see more money going your direction or into the slightly later funding because, well, rates are going up, perhaps the rest of the public market isn't looking so attractive?
Yeah, I think 2017 will be interesting in terms of venture liquidity because you have two paths, right? The IPO path, I think the pipeline's saying there's 35 to 40 companies that could go public in 2017, so we'll have to pay attention to that.
Still not a huge number.
Not a huge number, but, you know, double this year effectively. And then also, I think the M&A front is interesting because you're seeing offline companies, you know, Walmart buys Jet, GM buys Cruise. So you're seeing a new buyer of technology companies as they try to reinvent themselves. So I think 2017 could be a good year for venture.
And with the possibility of a cash repatriation that might be the Trump administration might lead with Republican Congress, Republican House, you could see companies with sudden big uses of, or big piles of cash ready to put to work that could be used for M&A because they want to get up and ahead with some of these new technologies and new consumer products.
I mean, it's fascinating looking into who raised the biggest funds in venture. In Europe, it was Deutsche Telekom was one of the biggest. So it is the older players getting into this venture plays. Where are the hot sectors if we're going to look at verticals in the tech industry? Is it all still about fintech if you're looking at Germany? I mean, you're in San Francisco, New York, Tel Aviv, but you also play in Europe.
Sure. Yeah, so I think there are several sectors. There's the deep technology, which I think is going to be a big focus in 2017, as I said earlier. So this is automation, not only automated cars, but automated enterprise across the board.
Robots.
Absolutely.
Huge.
You're going to see AI, you're going to see synthetic biology take off. So I think there's going to be a lot of capital away from these niche vertical marketplaces that feel like they're not venture scale. And into the
Uber of?
The Uber of everything, yes. Yeah. I think there'll be a lot less of that and more in deep technology.
Thank goodness, we'd used it way too much in 2016.
I mean, the venture capitalists I talked to, they would tell me even years ago, if the next person walks in his office, I've got the Uber of whatever, should just turn around and walk out of the office because that's been played out. It's been played out in the markets too.
I think we'll also see cybersecurity and fintech. You know, cybersecurity has been mission critical for a while, but as we saw state-sponsored hacks during our election, folks are realizing that this is a bigger problem than they perhaps thought.
So money has gone into perhaps VCs who are supporting the smaller rounds, the seed funding, the Series A. You're saying it's getting pretty hot out there. Sure. What is the funding scenario like that? If I'm an entrepreneur right there now looking for money, both here in the Bay but also outside, does it feel easy? Is it too easy to get hold of cash?
Well, I think the good news is it's a great time to be an entrepreneur. So if we look at a longer cycle, innovation is moving forward, and that's great for entrepreneurs, it's great for VCs. There have been massive funds raised in 2016, so while the funding pace has slowed, there's certainly an increased capacity for VCs to fund. So they can only sit on their hands so long before they have to deploy this capital.
What's interesting to me too is that a lot of the money that we're talking about, these big rounds, the late rounds for Airbnb, late rounds for Uber and so on, Pinterest, Snap, and other things, companies that were drawing money late, we're drawing it from T. Rowe. Yep. From Fidelity, from Tiger, from firms that wanted an IPO out, a way out with very late rounds, not the venture investments, the venture funds that have raised a lot of money. Traditional, Sand Hill Road venture funds have drawn in really big sums, which says to me that entrepreneurs with PowerPoint presentations and sneakers and a dog are going to get funding again a lot.
What about if we do see an element of 2017, what will it sum up for you, do you think? And what do you keep back to give to follow round funding if you suddenly got a few more players like the Fidelities coming in and maybe eating your lunch?
Yeah, well, I think it's not only the late stage folks, but we're seeing a lot of corporate and strategic interest in venture. So it'll be interesting, A, can we see the liquidity? Because ultimately the LPs are going to demand returns. And B, can we see some home runs in the deeper technology spaces, like we mentioned, and not just home runs in terms of returns, but from commercialization. Because I think 2017 will show itself as a refinement of these deep technology products, not necessarily full commercialization.